But nowadays, if you speak to younger residents who actually do invest their money, by and large, they invest in the US market. And when you ask them about like the Singapore market, they will just like look at you and like, what?
Why is it that Singaporeans aren't necessarily investing more at home?
Close to 60% or so of companies generate sub 8% ROE. There were so many accounting irregularities, fraud, directors gone missing, auditors gone missing, and how we can make Singapore equities great again.
What is your take on potentially separating Regco from SGX? Welcome back to Chills with TFC. I'm your host, Reggie, aka your Chief Financial Coconut, and today we're in studio to talk about a topic that many of you care about because you are a listener of the Financial Coconut. You care about your investment returns, you care about the vibrancy of the stock market, you care about all the good stuff. So, with that, I think you've already heard the government's plan and you've seen some of the activities and the market movements in the SGX. So, I thought that I will get the other side to come on the show to talk a little bit more about their thoughts, their plans, and essentially have a good discussion. So very happy to be in studio with Louis and Jameis.
Thanks for having us.
Yeah. So how has it been since re-election? since I got you on, I gotta ask all these things.
Well, it's been a year.
Almost exactly a year. It was May of last year when we campaigned. It's a bit of a whirlwind, I suppose. At some level, there's a familiarity. We're doing much of what we had been doing. But at the same time, you have more term is runway, I suppose. You have more runway to think about how we would structure various kinds of policy ideas that we have. And of course, this is one of those that we decided was relatively more timely and to start with.
And you guys, you won more votes than the first time you got in, right?
That's sweet.
I mean, yeah, the first time you can say you hing, right? The second time you made some gains in the
Exactly that.
you made some gains into your voter pool, right? So like how has that been? And that whole little bit, with your constituents.
We definitely appreciated the support that our residents gave to us, and I'm very thankful. And of course, we don't take them for granted. But I guess, in many ways, coming into this second term, it's a little bit like you take a little bit break to go into campaigning mode, and then you jump right back into the meetings, which you delayed for 2 to 3 weeks. So it's in many ways, it's just business as usual, us going about our MP duties, our town councillor duties. So it's just continuing to stay focused on doing what we need to do.
I mean, I got you guys on primarily because you tabled a motion, right? It's a motion?
It's an adjournment motion.
Adjournment motion, right? So essentially, you shared some thoughts about the capital markets, the stock market. You guys you guys work in the space, right?
We do, and it was a collaborative effort. So I think what was nice about it is Louis is much more of a micro finance kind of guy, and I'm much more of a macro finance guy. So you put them together, I think we kind of rounded out a set of.
Yeah. We will grill them in a while, okay? Yeah. But is it a very big concern brought up by your residents? Like, do they really care about this whole like stock market thing or capital market thing? Or were you kind of like responding to what the PAP government is pushing?
This is not one of those topics where every single person that you meet will talk about it, but definitely there are enough people who are concerned about this issue. I think in many ways, if you think about the Singapore as a financial center, global financial center, I think people would think that, we have a very thriving finance ecosystem. But if you think about it, during at least like our time, and definitely during our parents' time, when you think about stock market investments, you think about the Singapore market, the SESDAC, the STI. But nowadays, if you speak to younger residents who actually do invest their money, by and large, they invest in the US market. And when you ask them about like the Singapore market, they will just like look at you and like
you look weird.
like
what? Why you do Singapore?
But Reggie, I'll at least point out that, of course, as Louis said, there's still a lot of exposure to global markets, but stock ownership among the population is 1 in every 2. So there is certainly familiarity with the instrument in general and the investment proposition. So we felt that, especially given the amount of saving and the amount of assets that Singaporeans has, why is it that Singaporeans aren't necessarily investing more at home? Of course, ultimately, it comes down to returns if
Of
you
course.
talk about brass tacks. But even beyond that, you want to think about what is it that has inhibited our capital markets from developing even further.
That's the discussion, right?
That
So
it is.
because you are correct that I think for a lot of the retail investors, I think collectively most of our listeners, we're all retail investors. It's all about the returns, right? It's all about market activity, making sure that I can, compound and accumulate for retirement and all that. Right? I don't think people are really believing that it's gonna like totally change their lives, but they believe that if you invest in a market, you can compound and live a better life, right? So broadly, I think that's the base incentive for most retail investors, right? But people don't quite look into like what then create market vibrancy, what then can drive the whole activity. And I think the EQDP is probably like the talk of the town, right? It's been a while, there's this $5 billion that's been injected into the market, more like 3 point something now, there's more to be deployed. And then there are some adjustments to GEMS, the tax structure incentive for listing, so there's some stuff that the government of the day has already, initiated and deployed, and it looks like it's doing okay, right? It looks like the market, there's more activity. My business is doing better, right? So everything, and it's all tight, right? This whole ecosystem. So things look better, right? And then I want to hear your evaluation, of this situation.
I guess at the topmost level, what we can say is that the efforts are certainly appreciated. So it's not like we think that everything that has been proposed is a bad idea. If you ask us to summarize our sentiment, it would be that great, but we would like to see more. So it is that sense that we can do more fundamental change, more decisive changes that would really reinvigorate the local markets.
Which is why I guess the title of our adjournment motion that we put forth, I think about 2 months ago, was really how we can make Singapore equities great again, our own mega movement over there. If you think about it, it's definitely a great thing that has been put forth by the Equities Market Review Group, because just a couple of years ago, there are also questions that I've raised in Parliament about the state of our financial markets, our equity markets. So back then, I think in response to my PQ, my parliamentary question, it's always being said that, look, global markets are challenging. We are not the only ones that's facing some of these difficulties. So when there was that change in tech, when there was actually a deliberate effort to put together a committee to look into this issue seriously, I think that was an important change that we acknowledged. But really, having done this first round of your so-called supply and demand measures, probably there are still some missing gaps that we felt needed to be filled.
How about you elaborate a little bit more about like what gaps do you think needs to be filled?
If you think about it from a kind of big picture point of view, yes, we do have various demand and supply measures right now, and most important of which everyone can see, it's really the EQDP funds, the 5 billion, which has since been upsized to 6.5 billion. But beyond looking at the injection of funds into the market, we would say that there are three main buckets of changes that we want to bring forth. I think I'll elaborate on the first two, and then Jamus can talk about the third one. So this is what we have also shared in our adjournment motion speech for anyone who's interested to find out. The first bucket, I think this is where we think that the fundamentals need to improve. Now, why do we say that? So yes, you may have a lot of money waiting on the sidelines to be deployed into the companies here listed on the SGX. But at the end of the day, fundamentals will have to prevail. So if your companies are not generating the high enough returns on investment, returns on equity as opposed to global peers. So just now we talked about how capital always try to find its home to where the returns are the highest. I think whether it's retail investors, institutional investors, we all want to make sure that we invest well. And so ultimately, the companies that people are investing in have to be strong fundamentally. And this is where, the numbers may have changed, but I think based on our last calculation, about close to 60% or so of companies generate sub 8% ROE. If you compare to various other developed markets, the US, etc., I think, of course, the number is much higher. Now, if you think about the second broad bucket, and this also ties in with some of the legacy issues that the Singapore market has faced, it's really when it comes to governance and regulatory kind of oversight. Probably this is where we believe that when it comes to corporate governance, ensuring of reasonable minimum standards, that is one bucket which we feel we ought to continue to ensure as well.
So the third bucket is more for macro financial reform, and in particular to ensure that the whole process of capital raising. So ultimately, if you think about the stock market, what it is that it's one dimension of capital raising, if you will. If you look at the whole capital raising life cycles, the tail end of it. So to ensure that right from the idea of conception and when you have seed funds and when you raise venture, various different rounds, how do we ensure that we usher these babies through to adulthood in a successful manner? And I think that in the German motion, what I shared was that this would rely on both a matter of supply and demand factors. On the supply side, obviously, a big factor is that we have to make sure that we don't lose the baby along the way. And what we see, in fact, is that we have a very vibrant venture capital sector, I think, and which is among the best in the world. But somehow, when it comes to the final listing, lots of people go offshore, and they look for opportunities elsewhere. And so I think that was one key gap that we identified on the supply side. And now, of course, that itself is in part because on the demand side, there might not be enough take-up. And the take-up ultimately comes from a certain degree of transaction, a certain degree of volume and churn. And there, I made the argument that we should have incentives to greater encourage retail as well as institutional participation, especially from our sovereign wealth funds, into the local market, so as to generate some of this base level of volume that would generate activity that makes the market more exciting.
There's a logic to whatever you guys are saying, but there's also certain assumptions, right? And I think we need to definitely drill into some of these things. And what are we losing in this process, right?
Unpack away.
Yeah. So maybe we start with this legacy issue thing, because when I my 30s, when I first started investing, this was like maybe 9 years ago. I was primarily in the US market, right? So yeah, we had a good run, right? So and when I started looking at the Singapore market, right, then I start hearing like all these like S chip lah, this like fili fala things, right? That I was like, oh really? There are all these things, But as with all teething markets, they always have, problems, right? I mean, it's not just the listing market. Any market, as it grows, there are all these teething problems. But this seems to be like a thing, seems to be like an overhang across the market. When people talk about the Singapore stock market, they still talk about these things. I don't know if it's a perspective thing or is it like what's going on. So maybe you can elaborate a little bit on this like S chip thing. Like what actually happened. And then at the same time, maybe talk a little bit about like how do you think this thing can be changed, or has it already been done enough?
This whole S chip saga, it really wasn't that long ago. I would say, 10, 20 years ago was when you saw the first wave of this so-called S chips. And I think it's, for those who are watching and who have no idea what S chips are, you're basically looking at Chinese companies who actually listed here in the Singapore Stock Exchange. And basically, I think, I don't have the exact numbers, but there was something like 1 to 200 of such S chip companies that listed in Singapore. Unfortunately, many of them are slightly dubious, and along the way, there were so many kind of accounting irregularities, fraud, directors gone missing, auditors gone missing, and you think that there's like $5 billion in cash. Actually, when you go there, there's only 1 billion, and you think that you have huge operations over there. Actually, your assets are nowhere to be found. So there's a lot of all these, irregularities that were surfaced along the way, and of course, many of such companies eventually went bust. And I think shortly after this whole S-chip saga, again, you may have seen the certain court case, high-profile case about Blue Mont, account and the whole penny chip saga, which again kind of, it wasn't that all that long ago, probably about, close to 5-10 years ago. And in fact, I think the court cases were still pending just a couple of years ago. So all of these happened in very recent times amidst an overall environment where the number of listings in the SGX continued to decline. So it's not that there is no lack of quality companies on the SGX. In fact, there are many, even even though the number has continued to dwindle, and that's really because amidst all of these corporate and accounting kind of scandals, I think there really was a loss in confidence in the market. Retail investors were worried that the next stock they're going to buy might just end up like your China companies, which turn out to be non-existent. So I think that really left a very kind of a bad aftertaste in a lot of investors' mind that, the saying about how once bitten, twice shy. So beyond the blue chip companies that we all, know about, beyond that, I guess there was very little incremental confidence in the long tail of the small mid-cap companies.
But in a sense that underscores Lewis's point earlier on about the importance of accountability and transparency and ensuring that there's some regulation about corporate governance and adequate disclosure for some of these things over and beyond just what you would expect from the regular audits and so on.
On the ground, based on what I've talked to for a lot of these companies that are preparing for listings and all that, there's always a complaint, right? Which is the stack of paper is damn thick. Like the amount, like people take that whole prospectus and dump it in front of me. Say, you see, this amount of things that I need to tell SGX before I can go for listing. So and the fundamental first principle is always, if you have a lot of regulation, you increase friction, right? And then you will reduce the kind of activity that if you actually want more listings and more, new companies to go on the board, essentially, right? So where is this situation where since then till now, everyone that I've met tells me that there's a lot of requirements, and then at the same time, from your speech, you're like, we need more disclosures on this. And then at the same time, we want to increase market activity with more listings, promoting more activity. Like, where is this? How do we square this?
For those that have dumped the huge stack of prospectus at you, you can just tell them, look, next time your prospectus will be thinner because the regulations are going to be changed.
Okay.
So, that's some comfort for them. But I think on a more serious note, if you think about it, I don't know about you, but if I look at the SEC filings for US IPOs and US companies, I would say that the paperwork and the number of pages over there is way more than the SGX listed annual reports. So certainly that doesn't deter a lot of people from wanting to list in the US. In fact, some of the largest companies, largest private companies in the world right now, they are only going to be looking at the US as a listing destination. So I think that is just one part of the story. And the other aspect of it is also that, look, you may want to make it easier for people to list on the SGX, make it less onerous for them, less painful, so that hopefully more of them can come through. But I think we also ought to make sure that there is some QC involved and not that, look, any other company that wants to list can just come over here and it's like a free for all. So certain standards still have to be maintained.
Two more points. One is that there is a distinction, I think, that should be made between the initial requirements for the purposes of listing versus ongoing reporting requirements. And I think that as much as you dump a big prospectus, you have to make sure that subsequently there is a certain degree of accountability. And in many ways, that is almost more important because that ensures that the firms that are listed and generating activity are indeed going concerns and that we are keeping them accountable in that dimension. The other point I would make is that I would also probably want to draw a distinction, which I believe the government has also acknowledged, between listing on the main board versus listing on the secondary board, right? So certainly you want for that, especially for the more nimble firms that are listing with a relatively smaller cap and so on, listing on Catalyst, that's where you want to have a certain degree of regulatory flexibility, certainly more than you would want on the main board.
On that note, the speech that you talked about, the speech that you made, essentially tries to talk about how disclosures and regulation then promotes a certain kind of behavior, amongst the listcos so that they can be, clearer about what they're doing and show the investors more stuff so that they'll be more confident. I think that's layman term lah, right? So from your perspective, like why the need to do this? Because what you were trying to get at is that I need you to disclose all these things so that the market will be more confident or more intrigued about you as a company, right? And then potentially drive up the company's value and then, make them accountable, blah, blah, blah. But can you kind of walk me through that thought process?
At the end of the day, if you are buying a stock or you're investing in that company, you are a shareholder of that particular company. And as a shareholder of the company, you want to know whether or not the company does well or not. So, of course, if you are the majority shareholder, the substantial shareholder, perhaps you will be able to get access to management, the board. In fact, you may be in the board and so on. But otherwise, for the vast majority of minority shareholders, it is very important for shareholders to be able to take comfort in that the company is going in the right direction, that the management knows what they're doing, and at the end of the day, management or the company can create value for shareholders. Now, I think this is not something which we are also trying to reinvent the wheel. In fact, I think Japan and Korea have had very good regulatory changes that support this kind of train of thought, this particular direction, and they've made it very clear as to what they want companies to do, what they want boards of directors to kind of consider. So it's really not just about growing your earnings for earnings sake, to be as big as a company, as global as a company as you can be, but really whether or not you are able to generate value for shareholders, whether or not the capital is being put to good use, and whether or not you are good stewards of the funds, whether or not you have proper corporate governance processes in place to make sure that the company can continue as a going concern. And I think these are important things that are not necessarily things which you will see companies volunteering if there were not to be a carrot and stick kind of approach.
I know Mr. Chi replied to you with essentially his long and short is let the market do its thing, right? The market will seek out these things, and if there is enough activity, the fundamental assumption is then market participants would then want to stand out, and then they will disclose more and more to kind of highlight their difference, right? That's kind of broadly what his reply was.
Yeah, my difficulty with that approach is that is a little too sanguine. Ultimately, of course, there are reasons why you want government to be involved in public policy. The standard argument is that you want them because there's some kind of market failure. But another reason why governments can play a role in markets is as a coordinator. If both sides of the market are kind of waiting for one another before the dynamic kicks off, what you really want to do is to be the catalyst and kick things off by putting down a set of standards. That's why I also mentioned not just standards, but also in terms of generating demand. And if you have already major asset holders and major sovereign wealth funds that are able to become this linchpin of demand, then by injecting that kind of initial liquidity into the market, you can spark this virtuous cycle.
Hey, welcome to the Financial Coconut Podcast Network. I'm your host, Reggie, aka your Chief Financial Coconut. And if you're loving what we're creating here, like, share, subscribe, share with your loved ones, comment in the comment section below. And yeah, we'll see you for great content on Chills with TFC. Right, but maybe just one more on this regulation aspect, because sometimes regulation feels a bit abstract to the man on the street, right? And even sometimes I look at it, it's like, how does this thing then achieve that, right? And I really want to hear a little bit about this whole Japan, Korea, because you reference them, but in a parliament setting you can't quite, don't have enough time to elaborate. So could you kind of just tell us a little bit, maybe what are some things that were legislated on for the Japanese and the Koreans listcos that you think you would want to see amongst the Singapore listcos?
I think you have kind of hit the nail on the head. How does this kind of achieve that?
Yeah.
Because we really got no clue in the case of some companies. So if you look at the current disclosures for some companies, in fact, if you look at the annual report and you kind of read it from cover to cover, you still may not know what the company is doing. So it's like, okay, this can very well apply to company ABC. People spend a lot of time discussing about all these different specific measures, but ultimately, to me, it's about whether or not you are creating value. And so, a very good example of which would be, if you think about companies traditionally, when they first started out, they may be, set up by an entrepreneur, could be in family business, could be, subsequently majority still owned by the family. I mean, that's all fine and good. And of course, you may call the shots as to how you want to run the business because I know best. Akong did this, and that's why Akong has a vision. I'm going to execute on Akong's vision. It doesn't really matter what you think. But ultimately, at the end of the day, then if you decide that, look, I'm just not going to, care about my share price. I'm not going to care about my cost of capital. I'm not going to care about whether or not my remuneration as a key management of the company is aligned with that of minority shareholders. Then probably something is wrong somewhere. So that's the reason why in many jurisdictions as well, there's a lot of push, even in Singapore's case, to kind of link executive remuneration or remuneration of the board to specific KPIs to make sure that, look, they are really doing their job. It's not that we are super capable about wanting to put the headline or so and so person of this company made how many millions in this particular year. But to me, the more important thing is, okay, so this person made XYZ amount. What were his or her KPIs? Was that articulated by the board? Is this target aligned with the interests of shareholders? I think these are things which I think we need greater clarity on, just to make sure that they are not kind of, self-serving, but really serving the interests of all the different stakeholders and shareholders.
In a market situation, I can just not invest in you. Like if that is the company that this type of company that you're describing, right? Very ambiguous, not very sure, cover read already. It's like, what the hell are they doing, right? And I can just
But this is what I mean
not
by the
invest.
coordination.
Yeah.
If the entire environment doesn't require it, then you're not really standing out by not offering it, right?
Okay.
So and so that's when it becomes the opposite. It becomes like a race to the bottom where nobody is offering it, and you gain comfort in this anonymity in the crowd of not offering this additional information. Now the question is, why is it that no one in the market then decides that they want to stand out and offer this information? Well, that itself feeds it into itself, right? Because there is this coordination thing, and they're settled into a negative equilibrium. That's what we're trying to get them out of, in a sense, with some of these push.
One last thing on the regulation before we move forward. What is your take on potentially separating RegCo from SGX?
For me, I think I see both sides of the coin. On one hand, it is true that I'm an economist, so I'm a two-handed economist. So on one hand, it is true that by having those that embedded within the same umbrella, you ensure that there's more feedback between the two. You ensure that expertise will flow between the two as well, so that you truly understand what it is that needs regulation and what may not actually require as heavy a hand. So there's that argument. But of course, the other argument is that you want a certain degree of independence. It's much harder to have that kind of independence. The way that lots of organizations do it, including investment banks, of course, they have this Chinese wall between them, right? So they have them in completely separate arenas. But then, for me, what is most important isn't whether they are under one umbrella company or not, but whether or not they're independent or whether they're under the same umbrella, that the regulation arm is doing its job by not allowing this kind of race to the bottom. And I would appeal to the example that you see in the US. So in the US, they have many, many securities markets, and so they have different kinds of regulators, right? And it's well known that certain regulatory bodies are, like the SEC, is relatively stricter compared to others, like the CFTC. So the difficulty then is that you encounter a situation, especially with modern assets and instruments that are so overlapping in terms of their characteristics, that you have people doing regulation arbitrage, right? Shopping from one and another. So I think that's what we really want to avoid. We want to avoid a situation where the regulator isn't able, or there's a race to the bottom when it comes to regulatory action.
And from your observation at this point in time, it's just that there's an equilibrium, right? It's not directionally better or worse, right? And what you're saying is you want to change some of these things, hoping that you'll move down the positive side of things, right? Broadly, that sums up the regulation bit.
A number of years ago, the whole reason why they kind of carved out the Regco out of SGX was also acknowledging that, look, you probably want to keep the roles a little bit more distinct, even though they are both different arms of the SGX. And I think that's an important first step that has already been taken. But I think it's also at the end of the day creating the right circumstances to allow the people doing their jobs to do their jobs better. And to do so without the perception that, look, there's an inherent conflict of interest there. So I think that's a much more healthier and cleaner development of our whole securities landscape.
So now let's talk about the liquidity part, right? Driving market activity, opening up more participants, and I think you were very excited to talk about this whole GIC Temasek, potentially coming in to the market. From my understanding, they do not have a strict mandate on where they invest, right? They each of them, okay, they have their own little category, right? In terms of like what is their investment methodology? They have that type of mandate, right? But they don't have like a you have to invest in the Singapore stock market type of situation. And what you guys have said is that you want to see whether this could work, right? Like kind of driving. Essentially use the kingpin to try to like do this thing.
I do draw a distinction between GIC and Temasek.
Yeah.
And given the mandate of GIC, given how ultimately it is a long-term investor, you want it to be a long-term diversified and safe investor, generally I wouldn't say that it should be engaged in this kind of activities domestically. So you want GIC to retain its kind of global portfolio that is diversified and broadly in the big markets, because it is also a bigger beast. So you want it to give it that flexibility to look abroad. Temasek is where I think it's more intriguing, because if you think back, Temasek, of course, also started off by absorbing a lot of our local firms to begin with. And so in many countries that have sovereign wealth funds, they do have this distinction between a domestically oriented and a globally oriented investor. So I feel that Temasek can, in a sense, return to some of its roots. And while I wouldn't say that it should solely invest in the domestic market to the detriment of returns altogether, that would be a complete mischaracterization of my point. I do think that being a big player, you can provide this kind of undergirding for liquidity that will really help to ensure that no matter what, there's going to be some degree of transaction of activity. The other potential player, which I had also alluded to very briefly in the speech, is the possibility that CPF investors could also come into it. And to this, I use the example of Sweden. So Sweden is one of those where the retail investor has really come into the fore. If I have the number right, 8 out of 10 Swedes actually have some holdings in the stock market. And a lot of that is because of this encouragement through a number of incentives in Sweden by the government to ensure that the retail investor also takes exposure. And then, as we can clearly see, once there is enough activity, once returns are guaranteed, not guaranteed, but once returns are going to be less likely to become stagnant or to collapse over time, to wind down, then that's when there's enough confidence that more and more people will enter. And you want to kick off this kind of virtuous cycle. That's my whole point.
To be clear, it's definitely not about forcing some of these entities, whether it's GIC, Temasek, etc., to say that, look, you must invest in the Singapore market. But it's really about how, if you look at, for Temasek, for example, when some of these national companies were listed on the Singapore Stock Exchange, starting with Singtel and then subsequently some of these other companies. I think that was how perhaps there are a lot of Singaporeans that could then come on board onto this journey. So as we talk about how we want to improve the demand and supply situation of Singapore, the Singapore Stock Exchange, you always say that it's a chicken and egg issue, right? But yet, if you look at the portfolio of companies under the Temasek umbrella, a lot of them are still 100% owned. A lot of them are still private. Companies which, if you look at some of these speeches from 20, 30 years ago, companies that were meant to be listed are still private. So, why not let some of the best and the, most characteristic companies of our nation, Changi Airport, our ports, these are the things which we are, global leaders in. Why not just bring them to market just so that all of us can participate in the growth of these companies that we already have?
I'm sure there's a whole set of arguments against that, right? In terms of like, okay, some of these national giants, do you really want to float them in the market, right? So there's that side of the discussion, which is an endless loop, right? Both sides have both their points, right? So it is what it is. But on that part of like Temasek and providing liquidity and kind of like building that whole market in terms of exiting into the SGX, right? I've talked to some people, in the VC realm, right? The earlier realm of the VC spaces, which Temasek is quite active in also. Funds of funds, they do a lot of those things as well. And there is no requirement to say that if you take the Temasek money or you take any, VC that is tied to the Singapore, capital, that you have to exit in the Singapore markets, right? Because I think the theory is that, or the logic is let the listing fetch the highest price, right? So they will go to wherever that can fetch the highest price. And is it correct when I say that what you are trying to say is that, maybe there needs to be some strings tied to this thing? Same with your colleague, right? Kenneth went on a whole speech around this like billion-dollar unicorn that never lists on SGX, right? I can't remember the name of the company. Yeah, Meraxis, right? It's a biomedical. Yeah. Yeah. So he went on this whole thing of like, oh, we invest in it, blah blah blah, and then it never lists in the Singapore market, right? So maybe likewise, both sides have their point of view, fetch the highest price for capital recycling or create market vibrancy, blah blah blah, right? So maybe you can state your side of the
so
house.
I'll make a few points about that. First, Reggie, as you pointed out, it's clear that the argument that Temasek should never get involved in the local stock market because it is detrimental potentially to their returns, and so they shouldn't be bound by that. That's clearly an extreme argument that I don't think anybody buys, right? Because they are already getting involved in earlier stages. So there's nothing inherently prohibiting them necessarily from also getting involved with a listed company. That kind of distinction should at least be made.
No, but to date, there's none of these things also,
No,
right?
there isn't.
Yeah,
But I'm just
okay.
saying that if your argument is that they shouldn't get involved at all, that's clearly not true because they are already involved at an earlier stage.
It's kind of like natural, right?
Yeah.
It's not like mandated or in any way. So as long as there's value, that's what they do.
But in fact,
right?
for one of the vehicles, it is actually explicitly, of course, it's not enforced, but it's explicitly targeted towards encouraging some of these companies to seek a listing in Singapore. So there are specific vehicles that are meant for that purpose already.
Okay.
Yeah, so
okay.
the idea is to just create clearly stronger incentives. And if those incentives aren't sufficiently strong, then at least to ensure that there is also an upside on the other side. Because the last thing you want is that you provided some kind of funding to these firms. You took a small equity stake and then they list, and then most of the upside is captured purely by the founders. While I'm very sympathetic to the need to have vibrant firms, Singapore-founded firms. At the same time, you want to make sure that if you are an investor, especially an early-stage investor that has taken exposure, you need to be able to also be able to recoup a lot of the upside. You're not just doing this for charity.
But then on the note on CPF, right? Because now we are... I remember previously you guys were talking about like not binding the CPF money to the property market, right? But try to separate it. And now, based on what you're saying, you're trying to tell people maybe we could explore, right? Like CPF money into the Singapore market.
So I should be clear. This is
Yeah.
spoken in the context of the impending LRS.
Yes, yes.
And the LRS, the idea behind that is to give the possibility of CPF account holders a more certain pathway toward life cycle investment, if you will. And my point there is, if you're already going to set up some of these superstructures, that why would you not also incorporate somewhere within it, especially since this is Singaporean savings after all, to have a share that would be taking exposure to the local market? It doesn't have to be the largest share or the only share, but rather to at least have part of it provide that churn that we so desperately need by way of liquidity.
Currently, there's the whole discussion, right? I mean, I talk to some of these fund houses, so I hear little things like, oh yeah, they're talking and seeing what type of strategies work and all that. And you would say that within this life cycle investing system, that CPF is going to launch. They have said it, they're going to launch. It's just we don't know the details yet, right? That you think a part of it should be, carved or like mandated to be in the.
Put it more simply, the SGX should be a part of the diversified portfolio. That's all I'm saying.
I don't think mandated is the right word.
Okay,
it's really
too
just
harsh.
So
Yeah,
it's
yeah.
really just part of the buffet spread that you will see. And at the end
But
of
it's not about the buffet spread, right? Like the whole thing about the life cycle investing is because the buffet spread is not working.
No, so here's the thing. It's about, not right now the way that it's set up is that yes, you have the CPF investment scheme. You can do whatever one with your money. You lose all your money, and then that's too bad for you. And I mean, unfortunately, the reality is that if you look at the track record of CPF investment scheme account, those who actually use the CPF to invest their OA funds, SA funds, by and large, the majority of them are probably better off just leaving it in their accounts. And so we really don't want to leave it, on that it's a free for all, and you do whatever you want, and you are accountable for your own consequences. It's really one where we want to make sure that there is this whole LRIS equivalent, whatever that they will call it eventually. In fact, if you had worked in the armed forces or the or home affairs, home team, there's some of these things called your saver fund. So the regulars, for example, can decide to set aside a sum of money. They decide whether they want to be aggressive, they want to be conservative, and then it's invested in a diversified portfolio of stocks, bonds, whatever. And so this will then be managed according to the life cycle of whoever the service person is. So this is what we're bringing into the picture with CPF funds, just to make it easier, just to take advantage of the long time horizon. And we are saying that within this so-called diversified pool of global equities, global bonds, etc., probably Singapore equities should have a part to play in that.
We're not talking about a buffet in terms of all the options for funds that you can invest in, but rather that when you construct these distinct portfolios, the neutral, the conservative, the aggressive portfolios, that there is where the SGX should have a role in each one of these.
One last thing about driving the markets, right? Because the companies, after they get listed, then they enter the market, they have a certain mechanics in the market. But if we tie the whole thing as the stock market being the last bit of the capital raising cycle, it also underpins the economy here being not that huge, relative to like your Hong Kong, which has China listing going there, Japan, Korea, they have other industries that are much bigger that then exit through the financial, economy, whereas over here, it's kind of the same few things, over the past many years, we've not seen a lot more, of like new industries that are, very, very vibrant such that they then reflect that on the stock market. So then it becomes two things, right? Either you grow the industries, such that they become more mature and then they can exit into the market. Or the other one is then you got to bring in some of these companies that are like very mature, in the region or much bigger to then come in and list, right? So how would you kind of look at this thing, driving more companies, good quality?
For me, the latter, of course, has always been the holy grail, and it's not unique to this present moment. The Singapore model has always been a place where you can trust, where we set the rules, and because we are good at what we do, it becomes a natural venue for us to be the hub, the headquarter location, and so on. Of course, every country would want their own companies to be listing in their respective country stock markets. The trick is, how do we ensure that we become a preferred choice? And that is, at some level, a chicken and egg problem. But once you have that kind of activity, once it's just like what you were saying earlier on, Reggie, lots of people want to list in the US, not necessarily because the US is the biggest market per se, or rather the biggest economy per se, but simply because it is where you can get the highest valuations. Right. So if we can bring that to our shores, then we don't have to worry about being able to attract the regional players, because naturally they will want to be listing where we are. And that in turn brings us back to the earlier stages. How do we ensure that? Through ensuring that there is a lot of liquidity, that price discovery, as Louis was saying, is sound, so that we become this credible global financial markets. And I'll just point out one last thing, is this: it's not new to us. We are a global player in some other financial markets. If you think about, in particular, foreign exchange, we moved from somewhere fifth or sixth in the world to now becoming the third largest FX center. So it is entirely possible that we can be a global player despite the small size of our economy. We just have to get the fundamentals right, make sure that there's a lot of activity, and then the rest, one hopes, will fall in place. And our argument is just that it's not that we don't agree with the measures that have been taken thus far. We just think that it's too tentative, that they may or may not work. I wouldn't attribute the high activity that has occurred in the past year and a half necessarily to that alone. It would be great if it was, but I'm not as comfortable saying, just based on the record of the past year and a half, that it was because of these changes. But what I will say is that, to the extent that we are starting to see this take on its own virtuous cycle, that is what would continue to drive it. So that's ultimately what we are trying to all aspire toward, regardless of what your thoughts may be about policy and specific degrees in which these policies should take up. In the end, once it kicks off that process, then you can kind of let the machine do its own thing.
So ultimately, I think we all want a vibrant market, and I do think some of the measures as of now that's been deployed is driving some market activity. You hear more people that are trying to get listed. You hear more, fund houses launching new products, and a lot of them are getting like record AUM, into some of the new funds that they're pushing out. So all that is good, but I think you guys pointed out some of the parts that you hope could be better reinforced, right? So that we can then drive longer term. With that, thank you for sharing.
Thank you
you.
very much.
I hope to continue to engage with you guys on new ideas, right? So keep me in the loop. If you like today's episode, go to thefinancialcoconut.com to put your email address, or put in the comment section and say, whatever, you don't agree or whatever. so put it in the comment section, write your point of view, share with them. And ultimately, we all want this market to work. And that's all for the Chills with TFC today. We'll see you next week. Meanwhile, take care. Bye-bye.
Bye.